Hello and welcome to this April 2022 Investment Outlook video from Fidelity. I'm Ed Monk and I'm joined today by the Outlook's author Tom Stevenson to answer your questions about where Tom thinks markets are now and where they may be headed in the months ahead. You can see Tom run through his analysis for each of the main investing markets in a series of videos that are collected together online. You'll find them at the Markets and Insights section at fidelity.co.uk. Now, Tom, as always, we've asked Fidelity investors to submit their questions to you in advance, and I'm pleased to say that a great many have done exactly that. I'll just add that these are Tom's view of the market. It is not investment advice, but should be seen only as guidance. That said, Tom, let's get into those questions now. The first one is on a topic that is top of many people's agenda, which is inflation. And he says this, Tom: how come, with all the analysts and expert economists about, soaring inflation took us by surprise? Surely this was to be expected, as is US hiking interest rates. Surely this isn't a surprise. So what do you say to that?
Well, yes. I mean, I think we expected inflation to pick up. I think what has come as a surprise is the pace, the acceleration of inflation. And obviously that's been impacted by events in the first quarter. So the war in Ukraine is one factor. The lockdowns in China is another factor. So things have happened which have made an already slightly worrying inflation situation a bit more worrying.
And dwelling on the market's reaction to that, the market knew that was coming. We were talking about inflation coming through all of last year. But there was still a question about how the market would react and how it would really react to interest rate rises, because we've seen in the past it didn't tend to like them, even if it did have lots of warning.
Yeah, I mean, the market never likes interest rate rises, and I think that that's been the change over the past 3 months. We knew that the Federal Reserve was on the cusp of a tightening cycle, but I don't think we expected the pace of the tightening cycle to be what it's likely to be. We were talking about 2 or 3 quarter point rate hikes, even just a few months ago. Now we're looking at something rather more significant. Rates are probably going to go up to, maybe 3%, maybe a bit higher than that before they start coming down again.
Sure. Okay. Well, the next question, Tom, is related, I guess. It's about some areas of the market that people might turn to in a time like this. It says this: defensive stocks like food and utilities are tempting at times like this, but are they already priced in? What would such investments now be too late, i.e. buying at the top of the market? Your view would be very helpful as we begin a new ISA year. So what about those areas of the market, Tom, that have perhaps done well in this environment?
Yeah, well, I mean, the things that have done well have been, things which tend to be a protection against inflation or do well in an inflationary environment. So we've seen commodity prices, rise quite sharply, oil and gas in particular. Have they gone too far? That depends. That depends how entrenched inflation turns out to be, what happens with interest rates to combat inflation. But if you look back at previous episodes when inflation has been an issue, and I'm thinking in particular about the 1970s, then there was a distinct shift towards a different kind of leadership in the market, and we did see commodities, gold, those kinds of things do well for an extended period. So, I think we might be quite early into that process, actually.
And it's always a question for investors, isn't it? When a new change of the sort of investing backdrop comes along, things get priced in and markets move very quickly. But you've got to decide, don't you, when is your moment that it's fully priced in, that it can't surprise one way or the other? It's not always straightforward.
No, it is not straightforward, and you don't know how long these cycles are going to last. But I think what we've learned in the past is that that inflation moves in quite long cycles. So the Federal Reserve will move quickly to try and combat inflation, but it might be with us for some time. So I think that just because things have been moving for a little while and they you think that they're priced in, I think that process can continue.
So I think you're saying it may not be too late.
I think that's what I'm saying.
Okay, all right. Turning to the UK now, Tom. Why is the FTSE retaining its value despite COVID infections, inflation and the Ukraine conflict? And the UK has done quite well in this environment. Why is that?
Yeah, the UK has done well, and I mean, we're speaking on the day when we had some GDP figures out of the UK which showed that the UK economy effectively ground to a halt in February, and that was actually prior to the war in Ukraine. So there are things to worry about in the UK. And 5 million people have got COVID at the moment. So those factors that you mentioned are relevant. However, the UK is particularly exposed to some of the areas of the market which have done well. Got a heavy weighting towards oil and gas and commodities, and some defensive sectors like pharmaceuticals. So that's, I think, why the UK has actually turned out to be a bit of a port in the storm. It's been a bit of a safe haven in the last 3 months. In fact, over the January to March quarter actually has seen the UK being the only major market to actually rise in value over that period.
Yeah, it seems to have found itself in something of a sweet spot, doesn't it? Because prior to this year, I guess, you had the US leading the way. Those companies that were leading that stock market have been sort of undermined somewhat with that rising interest rate environment, the more inflationary environment. Now, perhaps we'll have an environment where it's Europe which sees a big challenge with energy prices. You've got the issue of Ukraine and energy supply in Europe. The UK isn't as badly affected by that. The UK does look interesting for all sorts of reasons.
Yes, I mean, I think the war in Ukraine is clearly having an impact, and the closer you are to it, the greater the impact, and that's for reasons which we've discussed about energy prices. I mean, countries like Germany and Italy are extremely dependent on Russian oil and gas, and so that's more of a factor for continental Europe than it is for the UK, and certainly for the US. So I think that you're right to say that the UK is in something of a sweet spot because it's far enough away from the problem. We have a greater diversity of sort of sources of energy, and we are, in stock market terms, we have an exposure to the parts of the market which are probably going to do better.
Yeah, and the next question, Tom, I guess is related to that. It asked this: if you've missed the commodity trade, what investments work in times of inflation and a hawkish Fed? So just explain the commodity trade first of all. What are they talking about there?
Well, I mean, I think they're talking about the sharp price rises that we've seen in things like oil and gas and the miners, for example. I actually don't believe I've already answered that question, and I don't believe that it is too late for that trade. But more generally, what does well in a more inflationary environment? Well, inflation is bad news for fixed income investments, for bonds. It tends to be better for equities, in particular parts of the equity market where you can find pricing power. Companies which are able to pass on rising costs, rising input costs, pass on those costs to their end consumers can do well. So I think you need to look under the bonnet, if you like, at the investments and look for companies which have the capability of thriving in that environment.
And just further to that question, a lot of these questions and the ones we can't address today are talking about assets that will do well in this environment. That's no surprise. But is it worth saying something about how much you should really turn to something like commodities within your portfolio? Because you might not want to completely shift all your money to something like that.
Yeah, no, I think that's fair. I mean, I think if you look back to previous episodes, I mentioned the 1970s. A more diversified portfolio in that environment would have done well. So a mixture of equities, shares, maybe some bonds, but certainly some commodities, gold, for example, maybe some property. That kind of portfolio, I think, will serve you well in that environment.
Okay, well, another different asset that people may be thinking of right now is spoken about in this question, Tom. It's this: if I invest in inflation-linked government bonds, will they protect my capital against inflation? Or do they carry the same risk as equity investments, i.e. they may rise or fall in value irrespective of what happens to inflation? Yeah, this is a question that I've had and that I know lots of people have around inflation-linked bonds.
Well, I think the question mentioned equity investments. I think actually the link is with bond investments, because an inflation-linked bond is at heart a bond. And so therefore it will be influenced by the same factors as any other type of bond, a nominal bond rather than an inflation linked bond. So if interest rates are rising, then that will provide a headwind for the bond element of the investment. But the fact that it's inflation linked, the fact that the income and the capital return is linked to a degree to the rate of inflation, I think will mean that it will suffer less than a traditional vanilla bond investment. It's
really hard, isn't it? Because something like that, you think, well, that will be a natural protection against inflation. Lots of other people are going to have that idea. And so prices are going to get pushed up. You risk buying when they're overpriced. And as you say, they're still a fixed income asset. That does mean they're impacted by inflation.
It does. I think they're part of the mix. I think, the bond portion of a portfolio should probably be more skewed towards inflation-linked bonds than it was in a low inflation environment. They're not a silver bullet. They're not the answer, but they're part of the mix.
Okay, well, change of tack, Tom, because this isn't really to do with equity or bond markets. The question is this: as a first-time buyer, how worried should I be about rising interest rates? A first-time buyer of property.
Yeah, absolutely. Well, I mean, the whole question of interest rates, whether or not you're thinking about investing in the property market, is an interesting one at the moment, because if you look at what the futures markets are telling us about the likely trajectory of interest rates, what they're saying is interest rates are going to go up quite sharply, quite quickly, and we're certainly hearing that also from members of the Federal Reserve who are teeing us up for some bigger rate hikes than maybe we expected 3 months or so ago. So yes, rates are going to go up quickly, but what the futures market is telling us is that they're then going to come down again. Now, why might they do that? They might do that because the central bank achieves its objective and it reins in inflation. That's the good possibility. The less good possibility is that it raises rates too quickly and actually damages the economy in some way, and so has to rein back its policy tightening in response to that. But either way, I don't think that interest rates are going to go high and stay high for too long, and that's certainly what the markets are saying at the moment.
Yeah, and this question clearly relates to what could happen with house prices as a result of interest rates going up. Now, interest rates going up, that will reduce demand ultimately in the property market. That makes borrowing more expensive. People can borrow less because they'll hit their sort of borrowing limits earlier. But we know, everyone really knows, that the property market is pretty relentless in the UK. It does tend to go up. Seldom do we have periods where it genuinely falls in value. And when you look at the economic backdrop at the moment, one of the things that stands out is that for all the cost of living squeeze, which hurts borrowers, and higher interest rates, which makes mortgages more expensive, we do have low unemployment. People will feel secure in their jobs. That's going to give them confidence to spend money on a property. That's what history tells us.
Yeah, I'd agree with all of that, and I would also say that a property, a residential property where you live, is obviously a part of your overall wealth, and you need to think of it as an investment, but you also need to think of it as somewhere to live. And if you take a long view, which obviously you do with a property investment, you're right that over time property prices do tend to go up. So I shouldn't worry too much about the ups and downs of the interest rate cycle in the short term.
Okay, well, let's move on. And the next question, Tom, is sort of to do with inflation, of course, but really how people should view their investments during a time like this. The question is this: during years of low or no inflation, for me, it seemed reasonable to look for growth of 6 to 8% per year from my investments. Is it now sensible to try to beat inflation by the same margin and to pick funds that might grow by over 12% a year? As if it were that easy. That sounds very risky to me. So what would a modest growth aspiration look like?
Yeah, I mean, short answer is no. I think that that it would be sensible for all of us to rein in our expectations. We are. We've been in a bull market for some time. Prices have been rising for a long time. They don't carry on in a straight line. Valuations are higher than they were. I think it would be sensible to rein in your aspirations.
Yeah, and particularly your after inflation or sort of inflation adjusted expectations, because the questioner is right. We've little over a year ago, inflation was basically 0.5, I think.
Yeah.
So that meant everything that you got in terms of positive return pretty much was gravy. That's great. You know, you get to keep all of it. It's just very different, isn't it? And the stock market can provide a return that sort of matches or can exceed inflation in the right conditions. But overall, maybe it's time, as you say, to park your aspirations of a return that's 3, 4, 5% above inflation. That's going to be hard to get.
Yes, but it's a good question to ask, because I mean, actually what you are interested in as an investor is the real return after you have factored in inflation. Now, if inflation is high, your investments have to work much harder to keep their head above water. And that is just the reality of it. And that is why it's so important as a policy objective to keep inflation low. You know, it's why Volcker was right, the head of the Federal Reserve in the late 70s and early 80s. He was right to focus on inflation then, and it's why the Federal Reserve and other central banks are right to focus on it now. We do need to get inflation down. It's very difficult to keep your head above water in an inflationary environment.
Okay, well, let's move on for now, Tom. The next question is this one. As part of my recent investments, I put some money into the 91 Global Gold Fund. We had a few questions about gold, actually. And as we are now in a new tax year, I'm ready to make some further investments. Given increasing global uncertainty, is pursuing a strategy of investing in precious metals a sensible one?
I think it's sensible as a portion of a diversified portfolio. I wouldn't put all my money in gold, but I think if we're looking back to templates from the past, gold has done well in a more inflationary environment. If we're moving into that, well, we clearly are moving into that environment. I think a portion of your portfolio in gold makes a lot of sense. And the fund which was mentioned here is one of our recommendations for the year. We like that fund. We like funds which invest in gold miners as opposed to just the metal. And the reason for that is if the gold price is rising, a miner's costs are relatively fixed, and so they should get a disproportionate benefit from a rising gold price. So it's a good way to get exposure to gold.
Yeah, and I thought this was an interesting question because of what you said at the start of your answer there, Tom, which is what's the correct allocation to something like gold? Because there are people out there who will look to gold. They'll buy into a very long-term story about why gold is going to go up over many years and decades. But for most people, I suspect that gold it's performing a very specific role, isn't it, inside a portfolio, and that is to act as this hedge under certain circumstances, and it's done that actually in the most recent period. Yeah. But you wouldn't want to have it as a core holding because it's very volatile, doesn't produce income, it's not going to generate earnings and profits in the same way. So you've got to get the role of an asset correct in your mind.
Yes, I mean, gold is essentially an insurance policy against things going badly wrong. So it's good to have a little bit of it, but I think, we're talking, maybe 5%, no more than that. Your core holdings for a portfolio which is going to serve you well for years to come, I think it should be in equities because that is where the long-term growth is. So the bulk of your investments, I think, should be in equities with some diversification and ballast and balance from other assets, like fixed income, like commodities, like precious metals.
Okay. Well, Tom, this is the final question, and it is this. Have technology funds been oversold, or is the place in the market now with value stocks given rampant inflation? So tech.
Yes, I mean, I think tech is particularly exposed to rising interest rates because of the nature of the profit streams from technology. They are valued on the basis of their future profits, and because of that, they do well in a low interest rate environment. So yes, I think that there is going to be a weighting more towards value stocks than growth stocks. But we talk a lot about diversification. These technology stocks are their value in a portfolio has not gone away. I mean, these are still dominant companies in our economy, and they will continue to be so. So yes, they're expensive, but they're expensive for a reason. They're good companies, and they're going to be a part of our lives for the future.
Which might make now a decent time to actually go and buy them. You know, this is the sort of environment where they're going to look less attractive. Investors should be looking for those things and doing the contrarian thing from time to time.
Absolutely, yeah. I mean, you know, plainly, their prices have come back quite a long way. Good opportunity, maybe.
Okay, well, Tom, that's all the time we have for questions now. Thanks an awful lot for coming in to answer them. If you've asked us a question that we didn't get round to answering, we have a special edition of the Money Talk podcast, which will answer yet more questions. You can listen to that on iTunes or wherever you usually get your podcasts. A full copy of Tom's Investment Outlook is also available to download at fidelity.co.uk/outlook. Thank you so much for watching, and do join us again next time. Bye for now.